All right. Once again, the word a word like correction has specific meaning. Mark Sebastian, we're only down 1.7% on the Dow from the highs. We're down 2.2% on the S&P 500. That's the most we're down right now. So correction is a little too much. My question is whether the traders down there where you are at the CME see a real correction coming, see something 5 to 10%.
Well, well, we're already off from the high more like 4%, because, we were up at about 1690 at one point. One thing I think you have to be really clear about is that concept of the Bernanke put that everybody was relying on. That's where we were getting this. We'd sell off 3.5%, and then everybody would rush in and buy the dip. I'm not so sure that's there. We've now tested 1650 3 separate occasions, failed each time. We've bounced off the 50-day moving average, which is right around 1605. I think we fail this time. Now, are we going to see an 08? I don't think so. Could we see something like a 2011 or a 2010 where we give away from the top 8%? I absolutely think that's in the cards. Now, one thing to be aware of, 2010, 2011, were those times that you wanted to panic and get out, or were those times you wanted to accumulate more? Those were both buying opportunities. So I think that you'd see the same thing. But yes, I think we absolutely will break the 50-day moving average sometime in the next 2 weeks. So probably between the next time we see each other, we'll be below 1,600.
Okay. Larry, I want to bring you into this because you're somebody that is advising clients worth about $50 million or more, the high net worth individual. How do you advise them, in particular, that older group that is trying to accumulate as much wealth as they can in the markets before they kind of basically get out and look to retirement?
Well, we're not trying to build portfolios that are based on having to be exactly right about when rates are going to move up or down. We recommend having exposure to lots of different asset classes and lots of different strategies. The strategies don't necessarily depend on markets going in a certain direction, bonds being of a certain yield. And so this is one of those things where people are talking about this a lot. People are attempting to trade around it. I think the smart thing is here for the types of investors that we advise is not to try to be too clever here and try to guess what the next exact move of the Fed is or how the markets are going to react to that. Most people are not going to get that right. And so having a long-term strategy of having exposure to lots of different asset classes is the way to go here, and that's what we're advising.
By the way, Larry, the deficit, we haven't talked about the deficit for a long time, but that kind of plays into your strategy as well. Explain.
Well, one thing that people need to keep in mind, and this really has to do with sort of the projections that the Fed makes when they are deciding how large their policy is going to be, as far as whether they're twisting or the QE3 policies. They're looking at what they expect the issuance of treasuries are going to be in the future, sort of in the next year or two. And so when they decide the sizes of those purchases, when you talk about the $45 billion of treasuries and the $40 billion of mortgage-backed securities, that is partially determined by how much of a deficit they think we're going to run during that next fiscal year and how much treasuries they're going to have to buy at each maturity level in order to get rates where they want them. So the deficit this year has actually been smaller than most people projected that it would be. Taxes coming into the government were higher than most people thought. The sequester, while some people expected it, it wasn't really factored in much to the calculations last year being made about this year's budget deficit. So as the Treasury actually issues less Treasury bonds and Treasury notes, the Fed might actually have to buy less in order to get the curve where it wants it. So not a tapering that they'd be doing because economic conditions are where they want them, but a tapering that might occur just because of the mechanics of them trying to push interest rates around.
Fascinating stuff. Brett, by the way, we shortchanged you, Brett. I just want your impression of where the rates go from here. What happens to the 10-year from here over the next couple of months?
Sure. Fed announcement or not, the technical picture on the 10-year Treasury yield has been one of a rebound. We were sort of in this multi-year decline that really took us far away from the long-term downtrend that the 10-year has been in for decades. And that resistance level, if you will, at the top side of that downtrend is about 4%. So, you know, it might take a few years to get there. It's not going to happen overnight. But it's very logical to expect that rates start heading higher, regardless of what the reason might be, whether it's Fed or otherwise.
Brett Falome, thank you very much. Can you imagine if Larry Hilzenrath and John Hilzenrath got together? That would be a scary.
That'd be a heck of a lunch, actually.
A scary
I think
lunch.
we should book them. Guys, thank you
Good
to
stuff,
all
gentlemen.
of you.
Thank you very
Appreciate
much.
it.
And
All
Mark
right.
Sebastian at the CME.